If you've been watching SanDisk lately, you've seen a stock behaving like a rocket ship. It was the S&P 500's top performer in 2025 and up over 100% in the first few weeks of 2026. But on February 2nd, something strange happened. JPMorgan suddenly suspended its rating. They moved SanDisk to not rated, citing policy restrictions. This almost always means a major deal is brewing. When a bank stops talking, it's usually because they're about to help the company raise a massive pile of cash by selling more shares. Why would SanDisk raise money now? Look at the chart. Since spinning off in early 2025, the stock has exploded by over 1,000%. It just hit a new high near $670. When a company's stock price rises this fast, management would be crazy not to consider a secondary offering. They can raise billions of dollars by selling just a tiny fraction of the company. It's the cheapest capital they will ever get. No interest like a bank loan. At these record high prices, dilution to current shareholders is relatively small compared to the war chest they built. Now, you might ask, don't they already have plenty of cash? And you'd be right. SanDisk's debt record over the last year has been a masterclass in deleveraging. They started 2025 with over $2 billion in debt from a spin-off. By the end of January 2026, they've crushed that down to just about $600 million. Meanwhile, their cash pile has grown to $1.54 billion. They are officially net cash positive. But here's the catch. The AI storage race is expensive. They extended their joint venture with Kioxia through 2034, requiring over $1.1 billion in manufacturing costs. They need to build fabs, secure supply chains, and acquire AI software firms to stay ahead. They aren't raising money because they're broke. They're raising money to fund an aggressive AI offensive. So, where does that leave us? If JPMorgan is prepping a share offering, we could see an announcement any day now. Usually, when a company announces new shares, the stock takes a temporary 5% to 10% hit. If you're wary of buying parabolic stocks, this JPMorgan move is a massive yellow flag. Buying at $670 right before a potential dilution event is risky. I'm watching the SEC filings closely for an S3 form. That's the shelf registration that makes a share sale official. My plan? I'm waiting to see if that offering happens. If the stock dips, that might be the healthier entry point. But buying the pre-offering hype? I'll pass. Let the company get its cash first, then we'll see if the valuation still makes sense.